Hello, it's good afternoon, everybody. I hope you can hear my voice and also see my screen clearly. So, as I mentioned in the morning, today's webinar is going to be about pin bars. We'll start by first defining what a pin bar is, and then we'll look at various kinds of pin bar if there are many, and then we look at cases where a pin bar is necessary. That cases where a pin bar is actually useful when you're supposed to be using pin bar for either entry or exit of trades. So a pin bar is not just any candle with a long tail and a small body. The color of that candle, when I look at a pin bar, the color is irrelevant temporarily. So the color is not significant. What is important is the tail, the size of the body, and then where the tail is. Like if we have something like this, assuming we have, I hope you can see this. This is red. Assuming you have this, and then you have a tail like this. So this is a pin bar. It is called the bullish pin bar. If you have another one like this, let's see, you have another one, then this is green. The color is irrelevant. So they all mean the same thing, that the price may likely continue to the upper side. So basically, when you have a setup like this is a bullish pin bar candle. The tail is always like 3 times the size of the body, and the same thing with the green one. The tail is 3 times the size of the body. That is, the body goes inside the tail 3 times. If you measure the distance from this to this point, it is, and you measure the distance between this point and this point, the distance for the tail is 3 times the distance of the body. It may sometimes have a tail at the top, a small, very small tail, but normally a good one should not have any tail at the top. So this is a bullish pin bar. A bearish pin bar looks like this, but it has a tail at the top. We have that. Then we have another one like this. We have this is a red. Like that. So either you have a pair which looks like this. If you have a candle which has a very small body but a long tail, it's red in color, or you have a candle which looks like this but it's green in color, this is a bullish pin bar candle. If you have a candle which has a very long tail at the top but very small body and very small tail or no tail at all at the bottom, this is a bearish candle. This too is a bearish pin bar candle. So ordinarily, according to books, according to what I've seen out there, anytime you see a bearish pin bar, it means that the next candle is likely going to continue to the lower side. And when you see a bullish pin bar, it means that the next few candles, they're likely going to continue to the upper side. So if you've been trading real time, you know very well that this is not true, because sometimes you could see a pin bar which looks very, very good, really, really good, but instead of price continuing down, it immediately goes straight to the lower side, to the upper side. Sometimes you may see this, a very good bullish candle, but instead of price continuing to the upper side, it goes straight to the lower side. So what normally causes this one? A case where, for example, you know this thing should be working like this. Actually, bullish pin bar candles or bearish pin bar candles stands for exhaustion. Like in this case, it means bulls are exhausted. In this case, it means bears are exhausted. That's why you see there's a tail at the bottom, and then here there's a tail at the top. So what normally happens? Why is it that sometimes it tends to work, sometimes it does not work? The reason is very, very simple. You fail to take into account what is overall happening before you look for a pin bar or a bullish or a bearish pin bar. For example, ordinarily they would say you'll sell it. If you see this, sell it immediately, have your stop loss at the high of those candles, then have your take profit at least two times the distance between where you've entered and the stop loss. Okay, that's according to the books. But in my experience, you must learn to take money when the money is there, and be as slow as possible to enter trades as much as possible. Like if you have a pin bar like this one, this is a bearish pin bar. Instead of entering instantly, have your pending trade somewhere here, and then have your stop loss somewhere here. By putting your entry here, you've reduced the distance between where you've entered and the stop loss. So that gives you the chance to have a bigger lot size. That's the first advantage. Then it also reduces the number of pips you are risking in a trade. If this was the distance, you'd risk much more. If this is the distance, you find that now the distance is very, very small, and if you're wrong, the price goes straight and hits you, and you know what to do next. So this is how I use it. There is a bearish pin bar, well and good. Do not enter trade immediately. Instead, have your pending, sell limit there, then have your stop loss at the high of this candle. The same thing with bullish pin bar candles, these ones. If you see a candle like this, don't just buy it immediately after the close of this bullish pin bar. Have a pending buy limit here, and then have your stop loss there. That is one thing. So the next thing is when they're actually relevant, so that you're able to use them the correct way. If you're that person who looks for moving averages, or you look for resistance levels, or you look for support levels, or you look for any dynamic levels to trade, then a bullish pin bar or a bearish pin bar must be happening around a key area for you to be able to use it properly. So the idea is not just to enter trade because there's a pin bar or there's no pin bar. No. If you have a pin bar around a significant resistance level, then you have a relevant pin bar around a significant level. A relevant in this case will be a bearish pin bar. So you have a bearish pin bar around a resistance level. That is a good place to look for a sell from. That is always the best place to look for a sell from. Not anywhere, because sometimes like we may have a level like this. We may have something like this. So I'll draw it so that you're able to see it clearly. Look at this. We had a support here. We had a support there. The price went up. It came back. Then it formed a pin bar around the same place. So this pin bar is relevant. Despite the fact that we bought it and the price went and took at our stop loss, this was still a second buy. So you could have bought it there, but you could not have bought it after this pin bar here, because this is inside the whole shape. So the first case is to use it when it is happening around a clear area. Like if you have a very good support and a pin bar forms around that area, use it. Another case is when you have a very good resistance and then a bearish pin bar forms along that resistance. That's also somewhere else where you use it. Let's look at that. Let's get a good example for that one first. Okay, look at this one here. We had a very good resistance here. We had a resistance there. We had a resistance. There was a perfect bearish pin bar. Instead of price continuing down, it came back and took your stop loss before eventually going that way. So that's not a bad one. You don't have to be correct every day. You don't have to be correct every time you're entering a trade. Sometimes you may enter a trade perfectly well, follow all procedures, but the price may still just go against you. That's not a sign that you don't know what you're doing. No. You still know what you're doing, just that the price violated what you know. Is that clear? So if you took a sell here and the price stops you out at this point, do not in any day say that you don't know what you're doing, or start revenge trading, or say that, okay, I've lost this, let me look for a new strategy. No. If you remain with this strategy, you'll eventually find that you're successfully trading in the long run. So those are two cases. Those are two cases where we found that if you have a resistance, you look for bearish pin bar along that resistance level. If you have a support level, you look for bullish pin bar along that support level. The next one is if you have a clear trend and the price gives you a pin bar in line with that trend. Like when we have something like this. We have a bearish pin bar here, a bearish pin bar here, and then you see that there is this indicator is showing us a sell signal. So these are the cases where we could have taken that sell without thinking. We could have taken a sell. We have some candle which looks like a pin bar, not a very good one because it has a tail at the bottom. And then you have another one. This is a pin bar. Doesn't look very good because the body is a bit big, but we have a pin bar here which is not a good one. It is against the overall trend. We have another one there which is not a very good one. It's against the overall trend. So you could have taken a sell here, you could have taken a sell there, expecting those sells to push price downwards, at least up to where the price could give you a good number of pips. So that is another case. Look for a clear trend irrespective of the indicator you're using, or you're just using moving averages, or you're using just any indicator to identify the trend. Use those indicators. Then if a pin bar forms in line with that trend which you're currently seeing, then you trigger that position. Is that clear? So this is where most people go wrong. They believe that when a pin bar shows up, it's automatic, it's natural, that the price must go in that direction. No, it's not always automatic. It's not a must that whenever the price goes, it's not a must that whenever you see a pin bar, the price must go in that direction. No. If you are in line with the trend, or you are around a clear area and a pin bar forms, then enter that trade. If it goes against you, well and good. If it works for you, well and good. Then something else. If you want to make money also, do not just come up with some figure that, okay, I'm going to be using a volume of 0.01. I have my stop loss at this point. No. Or I have my stop loss this number of pips. For no reason, you're just having your stop loss anywhere. You are willing to risk just any amount. No. The first thing is your stop loss should be based on the high of that pin bar itself. Then the amount you are risking from the point of entry to where the stop loss is should be a proportion of your account which you identify. That is like 5%, 2%. Then the lot size which you'll be putting on that sell position must be based on the number of pips you are risking here from this point to the stop loss, and also the percentage of your account that you're willing to put at risk. That's when you'll get. So you'll say that for every pin bar I see, I only risk 5% of my account, or I only risk 2% of my account, instead of risking just some number which you don't know exactly how they come about. Are we clear? Okay, so there's also some pin bar here. This is a pin bar. It's not good because the price eventually went against it, and also the indicator we are having was giving us an opposite signal. So this is why we won't be regarding this in any way. So let's see, there is a pin bar here. You can see it has been recognized. The price went down. There is no other pin bar except for this one. We have a bullish pin bar here. So despite the fact that the price pulled back up, we can't still sell it because the indicator is showing us a sell. So we don't want to sell anything that's going against us. So that should be the end of our today's session. I know it has been a brief one. We'll meet again next week at the same time. Thank you and see you.